uh, Governor. We have the last financial year. We saw a massive shock to consumer demand. Uh, we saw a GDP contraction of 7.3% in 2021. But as soon as the year ended, we were in for a bigger shock, which was a brutal second wave of the pandemic. We saw loss of jobs, loss of income. People even had to pawn their gold to meet their daily expenses or their medical expenses as well. Just 7 months back or 8 months back, you talked about the winter of discontentment will be made into a glorious summer sooner than later. Now, since January till September now, how do you look at the prospects of the Indian economy, of the recovery? Do you think that we're going to feel the chills for some more time?
Thank you, Vedyanathan, and thank you, Amy, for having me here. And a very warm good afternoon, good evening, or good morning to all your viewers. Now, you are absolutely right. I mean, during the April monetary policy meeting, which was held, I think, on the 4th or 5th of April, I did say that the economy will now move only in one direction and it will move upwards. And that time, of course, we had qualified by saying that qualified my statement by saying that we have not factored in a resurgence of a new wave of the pandemic, or coming in of new mutants or variations of the COVID virus. Now, we said it on the basis of the fact that the first quarter growth of this calendar year, that is Q4 of last financial year, in other words, the January to March quarter, our growth was positive, in the positive territory, and it was looking good. All the indicators of growth were looking very optimistic. Then, of course, from somewhere in the middle of May, middle of April, the next second wave set in, and it became very severe and quite widespread in India. So from about middle of October, from the middle of April to, let's say, the end of May, it persisted. So therefore, this caused a big dent on the growth. Now, the first quarter growth numbers have come in line with our projections. That is from April to June, which broadly covers the the impact of which bore the direct and immediate impact of the pandemic. That is already factored in into the first quarter growth. Lingering effects of the second wave, of course, did continue into July and a little bit into August. Now, going forward, how we see the growth? Yes, the fast-moving indicators, are looking quite. Many of the fast-moving indicators, not all, many of the fast-moving indicators are looking quite upbeat. We track about 100 odd, fast-moving indicators, and I can mention some of them, like for example, the sale of two-wheeler vehicles, the sale of passenger cars, or the steel and cement production and consumption, the GST e-way bills, the electricity consumption, the tractor sales, and there are several parameters, and several of these fast-moving indicators are looking up. So therefore, at this point of time, our projection of 9.5% growth for this financial year stands, and I think it will hold good. The second quarter of the current year, that is the current quarter, will do better sequentially than the previous quarter, but there is a base effect of last year which will have its impact throughout this year, but the base effect will gradually moderate going forward. So we are quite optimistic, and quite at this point of time we are quite optimistic about the 9.5% growth which we have projected for the current year. Having said that, I must say that uncertainty of a possible third wave, which people are talking about, that uncertainty still remains. But just half a minute more, I think people and businesses are now more adapted to the COVID protocols and more adapted to continuing with their activities, business activities, and other activities, even when there is a COVID. But again, everything depends on the severity and the spread of a third wave of the pandemic, should it happen.
Governor, ever since the pandemic began, the RBI has really been very, very supportive and accommodative in its monetary policy. There was a lot of increased liquidity. There was loan forbearance for MSEs, small and medium enterprises, and generally interest rates have been held low. But with inflation getting close to 6%, I'm wondering if you feel that there's still space to continue with these accommodative policies. Is there a concern that inflation is beginning to become generalized in the economy? And is it time for tightening? And I wonder if you also feel that the government has space for more fiscal measures to support the recovery and ensure that it doesn't lose momentum.
Okay, on the fiscal space part, I would like to say that right from the beginning of the pandemic, the government has been taking calibrated measures, targeted measures. And from time to time, whenever we have any suggestions with regard to further fiscal measures or fiscal support to particular sectors or particular subsectors, we do internally flag them to the government, and the government takes them into consideration, and whatever possible the government does it given their financial their fiscal deficit constraints. So therefore, whether the government has further room or not, I will not give a straightforward answer of a yes or no. I would only like to say that we do communicate it internally to the government from time to time, and that practice still continues. Now, coming to the issue of inflation, you said that the inflation is sort of remaining around 6%. Is it a matter of concern? As I have said, and as the MPC statement, the last MPC statement says, and as I have also said in my own statement, that the current inflation is mainly driven by supply side factors, partly because of international factors built around high commodity prices, the high shipping charges, the container costs, and mostly international commodity prices going up. That is feeding into domestic inflation. And domestic factors, yes, the high pump prices of petrol and diesel, and also certain commodities, certain items like the pulses or the edible oil. Now, this is one area again where we are constantly engaged with the government. On pulses and on edible oil, government has taken certain measures, and they have had their effect. So with regard to inflation, we monitor the situation very closely, and let me make it very clear that the RBI is an inflation targeting organization, but in the pandemic times we have decided to focus on growth, more emphasis on growth, because if the growth completely gets decimated, then it will pose huge long-term challenges for the economy to revive. So during the pandemic, therefore, instead of the exact target of 4%, the MPC has decided to operate within the band of 2 to 6%. So at the moment, it looks that the inflation, which exceeded 6% for a couple of months, they have now moderated to 5.6% in the last print which came out. The next print is due next week. And our expectation is that from now on, the inflation will gradually moderate. So the possibility of a sustained increase in inflation beyond 6% is highly unlikely at this point of time. But nonetheless, we are watchful. We are very serious about anchoring inflation expectations and anchoring the inflation around the target of 4% going forward. And we remain committed to anchor that. We remain committed to achieve that over a period of time in a very non-disruptive manner.
Governor, if I may just, as a sequence to what Amy said, and you told us about anchoring inflation expectations, do you think that, given that you don't really expect inflation to be at sustained 6% levels or higher than that, do you think that you can continue with the accommodative stance for pushing growth And also, does the worry that increased money supply is feeding some other asset bubbles? Like you have earlier also talked about stock markets at at levels which are kind of very high. Does that worry you?
You see, with regard to, I think you asked two parts of the question. The second part is with regard to whether it is feeding into inflation, and the first part, I think you mentioned about, the whether inflation sort of. I think you said whether the inflation is exceeding. What was that point? Can you just repeat?
Whether given that you don't expect inflation to go over 6% on a sustained manner, does that give you enough space for monetary continuing with the monetary
Yeah,
accommodative
yeah.
stance here?
Correct. Now we had adopted the accommodative stance even before the pandemic set in. Sometime in 2019, we had the MPC had decided and adopted the accommodative policy stance, and we had started a cycle of rate cuts in February 2019. But if I remember correctly, in December monetary policy, and again followed by that in February 2020 monetary policy, the MPC decided to pause with regard to the rate cut cycle. So there was a pause in December of 2019, and there was a pause in February 2020. So India's growth had moderated. So MPC had responded to that challenge, and that time the inflation was well around within 4% and around 4%. But once the pandemic set in, I'm just just putting it, repeating it because it explains things in a perspective. Once the pandemic set in, we went for about 115 basis points. First 75 basis points cut, then we did a 40 basis point rate cut. Now, whether we will continue with the accommodative stance and we will sort of look at the rates, etc., that is a decision which the MPC will take. But nonetheless, my assessment and our assessment in the RBI is that, or the way we look at the things, it is as follows. Number one, we are very closely watchful of inflation, and this deviation from this sort of not deviation but operating within the within the band, that was a specific need of the COVID times. We are watchful of the growth impulses becoming sustained, the growth impulses taking deeper roots. We are watchful of the inflation dynamics and the inflation curve, which is expected now to moderate. And as I said earlier, going forward, we will definitely sort of our effort, being an inflation targeting organization, institution, our effort would be to gradually move to 4% over a period of time. But that timing has to be decided. Today is not the time, and we will take a call depending on the incoming numbers. With regard to high liquidity position, let me tell you that the current inflation, as I said, is driven mainly by supply side factors. And at the moment, there is no evidence to show that the high liquidity is feeding into general prices. Number one. Number two, there is some, yes, global liquidity is not only surplus in India. Globally, central banks have infused a lot of liquidity. So globally, there is a surplus liquidity, and the stock prices are very high and are booming in almost every market, including India. But there is no evidence, and to some extent, the current high stock prices in India have been influenced by the excess liquidity. But second point which I wanted to mention is that there is no evidence of high asset prices, namely the high stock prices, feeding into general inflation or general prices. So therefore, high inflation getting generalized, we do not anticipate that kind of a scenario to occur.
Governor, I'd like to, if I may, turn to the banking sector. Even before the pandemic, the banking sector had been wrestling with high levels of bad loans and had been struggling, although there had been a lot of progress made on trying to resolve the bad debt burden. How much of a setback has the COVID pandemic been in terms of a new wave of bad loans? And what are you seeing in terms of the stress on banks' balance sheets?
You see, in the last financial stability report, we have given scenario, a baseline scenario, and we have given a scenario of severe stress. Even under a severe stress scenario, our the GNPA, the gross non-performing assets, we have projected at 11.2%, 11.22% to be precise, and the 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 resolution packages which we announced last year in August and again this year in May, especially for small and medium businesses, for the MSMEs. Uh, this time, the resolution packages are not open-ended. They have a starting date, they have a completion date, and a time limit is set within which the restructuring of the loan portfolio has to be done. We have also insisted that while doing a restructuring of a particular portfolio, the banks will have to make a provision. Simultaneously, they have to make about a 10% provision in their, in their books for all those restructured assets. So therefore, and that will act as a buffer in the event if a particular restructured asset falls by the wayside, or if it has develops further stress. As the numbers, according to the numbers which we have currently, the NPA levels look quite manageable. And for example, the last data at the end of February, which we at the end of June, for the banking sector, it's about 7.5% GNPA, and for the NBFC sector, it's a little less than that. And the capital record, the capital app, the CRAR as we call it, capital to risk weighted asset ratio, that one CRAR for scheduled commercial banks overall at the aggregate level is at about 16%, and NBFCs is about 25%. And the other thing we did last year and even now is that we have impressed upon the banks and nudged them to raise additional capital proactively in anticipation of some stress which may arise. And I'm happy to note that most of the banks, including private and public sector banks, have mobilized additional capital, which should stand to their defense if there is an increase in the stressed assets. But as I have said, at the moment, the situation on the front of stressed assets look well within manageable limits.
Yeah. Governor, one of the things which has been, bothering some in the markets is about this, banks taking huge haircuts in terms of, when it comes to resolutions of big defaulters, as high as even 90% at times. At the end of the day, it is all depositors' money. What has been, does that concern you? What has been your conversation with banks on this? Are there any lessons for that the RBI would take as we move forward in the insolvency part?
You see, first thing about this this IBC, the Insolvency and Bankruptcy Code, that the measure of success of IBC is not what percentage of recovery takes place. Yes, it is an important factor, but the primary objective of IBC is resolution of bad assets to wherever possible to resolve the business so that the company or the business continues its operations, and the economic value which that business creates, that continues unabated. The intention is that if the functioning of a business or a company continues, jobs are also protected. So the business continues, economic activity continues, and jobs also remain protected. The idea is not to allow, if it is possible and if it is viable. Of course, if a business is not viable, then of course it has to be a different route. Now, that is the first aspect, that the effort is to see that the business continues, the activities continue. The second, coming to the recovery percentages which you have mentioned, the average recovery under the Insolvency and Bankruptcy Code is was about 45% for the previous 4-5 years. it came down to 40%. I'm talking about average at the aggregate level for
Average.
all the reserve. Yeah, it's 40%, taking into account the pandemic year. Now, yes, some cases the haircut has been 90%, but there are cases where the haircut has been much less. And with regard to the further improvement of the IBC framework, we have, yes, I agree that there is scope for improvement in the, there is scope for improvement in the functioning of the IBC and in the framework. There is perhaps need for certain legislative amendments also. We have some suggestions which we have flagged to government. For example, the process of the time taken to admit a case to the NCLT, the admission itself takes a lot of time. So can we deal with that issue through some legal amendments? The IBBI has also come out with a governance document with regard to the functioning, on the various issues. So that also we are examining. So there is scope for some improvement, and the time taken in the whole process, I entirely agree, needs to be reduced by simplifying certain procedures and wherever necessary by carrying out legislative changes.
We're starting to run out of time. I'd like to put a couple of the audience questions to you. Number one, I'd like to ask, why is credit growth being so slow to pick up? Is it that demand is slack due to low prospects, or are banks cherry picking customers because they're reluctant to lend?
You see, what is happening is that for the regulator, we have to provide an enabling ecosystem where the banks are in a position with adequate capital and with adequate resource, with adequate liquidity and capital to give loans. Beyond that, it is a function of the market. Now, why the offtake has been low? I would feel that it is primarily because two factors are important. Primarily because of the uncertainty which still prevails with regard to the COVID pandemic, and with regard to the what kind of impact it will have on the economy, and whether the markets, the revival of activity will be sustained and will be I think there is still some uncertainty in the minds of the business, especially emanating from the pandemic's the future curve of the pandemic. So that uncertainty continues. The second thing is that during the last 1 year, because of the liquidity which we have provided, many medium and large businesses, they have deleveraged considerably, and they have enough space in their balance sheet to invest. Perhaps they will invest when the time comes. The third point I would like to mention is that what you call the I think there are investment plans, and it should be, there is still a lot of slack in capacity utilization. The current capacity utilization in factories is still way below, it's still falling short of the pre-pandemic levels. There is a slack in the demand, there is an output gap, and there is the aggregate demand is also below the pre-pandemic level. So therefore, I think there is a lot of wait and watch which is going on. Once the business gains confidence that the economic improvement, that the GDP restoration or the revival of activity will sustain, I think that should be a point where there will be investment and will lead to a demand for credit. The latest number which has come out is about 6.77% year-on-year growth with regard to bank credit, which is marginally higher than the previous number, which was published by the RBI.
Oh, I'm very tempted. There's one more question that is on a lot of people's minds. If in a very short answer, can you tell us your thoughts? Should India adopt cryptocurrency? Or
we
maybe
have conveyed our serious and major concerns. We have conveyed our major concerns to the government about cryptocurrencies. Serious concerns, major concerns from the point of view of financial stability. Government will take a decision, and I think we need more credible answers as to whether going forward the whole private cryptocurrencies, what contribution it will make to Indian economy going forward. I think we need more. We need to be convinced more with more credible explanations and answers. And so therefore that is how I would like to sort of explain our position. And it's now for the government to really sort of take a decision in the matter.
I'm afraid we're out of time, so I'll hand
Yeah,
over to Bedi.
yeah. Thank you so much, Governor.